Chapter 4, Gift and Estate Taxation. Gift taxation applies to property transferred while the taxpayer is still living. You can't just give your own money away as you see fit. No, you will be taxed if your gift falls outside of the arbitrary boundaries. So let's discuss gift tax from a donor's perspective. A $15,000 exclusion per spouse is allowed. So essentially, a married couple can give a person $30,000 and not be taxed. But say, for instance, that a couple gives someone $32,000 cash to a friend, that's a good friend, the amount of the gift taxable to the couple for gift tax purposes would be $2,000. It would be $32,000 gift minus the $30,000 exclusion. In order to get the exclusion, the recipient must immediately acquire a present interest in the property and get unrestricted access to the property and all of its benefits. If the recipient merely gains a future ownership, then the present value of the gift is 100% taxable to the donor, and you cannot exclude from the gift tax calculation. Now, if the gift is an annuity, use the present value to determine the gross gift. So here are some items that are exempt from being included as taxable gifts. Tuition and medical expenses that are paid directly to the organization. So if grandma and grandpa pay Billy's college tuition, they need to pay it directly to the university, not to Billy, if they want to avoid the contribution from being counted as a taxable gift. No books or dorm fees, however, are allowed for the exemption. Additionally, political contributions, charitable gifts, and unlimited lifetime gifts to spouse are excluded from the calculation of total gifts. So that's from the donor's perspective. Let's talk about from the donee, the recipient's perspective. Property received through gifts is not income to the recipient. If the property is received and then later sold, then there's some tax issues. So if it's sold at a loss, well, the question is what basis, so you have this property, it was given to you, like what is your basis in the property when you sell it? So you can calculate your gain or loss. In this instance, it's a loss. Then the donee's basis is the fair market value on the date of the gift because they want to minimize how much loss you can take. If the property is instead sold at a gain, then the basis is the same as the donor's because they want to maximize the gain. So in theory, they held it for a long time, they gave it to you, probably has a pretty low basis. If the sales price is greater than the donor's basis, but less than the fair market value at the date of the gift, it's kind of in that middle range, then there's no gain or loss. Let's talk about gift tax returns. Gift tax returns use a calendar year basis only, and they are due on April 15th. Now, if appreciated property is gifted and the recipient dies within 1 year and is transferred back to the original owner after the death, then the basis reverts back to the decedent's basis prior to the death instead of the basis increasing to the fair market value. So that's how that works. Basically, if you gift someone property worth $10,000 and has a basis of $1,000 to someone about to die, and then the property passes back to you from their estate, normally the basis would be the fair market value at the date of death, $10,000. But the IRS won't let you do that. Your basis reverts back to the decedent's basis, which was $1,000 from when you gifted the property to them. Let's talk about trusts. We will discuss two types of trusts, complex trust and simple trust. With a complex trust, income distributions are optional and accumulation of income is okay. Charitable contributions are okay as long as they aren't contributed using tax-exempt income. The key point of complex trusts is that distribution of the trust corpus, in other words, the principal, is okay. With a simple trust, income distributions are mandatory and accumulation of income is disallowed and no charitable contributions are allowed. And distribution of trust corpus, again, the principal is disallowed. So let's recap the difference. You can remember them by complex trusts being more mature. Simple trusts are more like a young child who knows just one word, no. Income distributions, complex, yes. Simple, no. Accumulation of income, complex, yes. Simple, no. Charitable contributions, complex, yes. Simple, no. Distribution of trust corpus, complex, yes. Simple, no. Some more general information about trusts. Expenses and fees from tax-exempt income are not deductible for either a complex or a simple trust, and trusts can have a net operating loss, and any unused net operating losses flow through to the beneficiaries. Moving on to estate taxation. Estate tax deals with property that's transferred after the taxpayer's death, whereas gift tax deals with property that's transferred while the taxpayer is still alive. And for the 2020 tax year, the first $11,580,000 is exempt from estate taxation. That's $11,580,000. Now, medical expenses paid after death but incurred within 1 year of death go on the decedent's personal tax return. Estate tax credits are granted for foreign death taxes only. Foreign income and gift tax credits are disallowed. Since the estate tax is a death tax, it makes sense that credits for foreign death tax paid are allowed, whereas other foreign credits are not for purposes of taxing the estate. Estates, like trusts, can have a net operating loss, and like trusts, any unused loss flows through to the beneficiaries. So let's talk about how to calculate the net estate tax liability of the decedent, the person who died. You begin with the gross estate, which is cash plus fair market value of the property at the date of death, or the alternate valuation date, which is 6 months after the death. So you get to pick. You take the gross estate and then subtract the following: funeral costs, estate admin costs, debts or mortgages, casualty losses, charitable bequests, state death tax paid, plus you add any receivables that they were due and subtract any additional payables that they owed, leaving you with the decedent's taxable estate. So let's repeat that one more time. The taxable estate is the gross estate minus funeral costs, minus estate admin costs, minus any mortgages or debts, minus casualty losses, minus charitable bequests, minus state death tax paid. Then you add any receivables that you were due, that the decedent was due, and subtract any payables that they owed, and that's the taxable estate. Then you take the taxable estate and you add taxable gifts that they paid out, giving you total taxable amounts. Then you take the total taxable amounts and you multiply that by the estate tax rate, which you don't need to know for the exam. That gives you a transfer tax. So stick with me, one more step. You have the transfer tax. Then you back out foreign death tax paid. That gives you your net estate tax liability. So what is the takeaway from all of this for exam purposes? I think that you need to know that what the deductions are to arrive at the taxable estate calculation, which one more time are funeral costs, estate admin costs, debt or mortgages, casualty losses, charitable bequests, state death tax paid. So let's talk about estate tax and joint tenancy. This is when two non-spouses jointly own property. You take the fair market value at death times the ownership percentage, and that amount is included in the state. So for example, take a brother and sister who bought a piece of property. The brother paid 75% of the property, sister paid 25%. The fair market value is $100,000 at the sister's death. Well, 25% or $25,000 goes towards the sister's estate because she owned 25%. So $25,000 goes to the sister's estate. Then there's estate tax, which is tenancy by entirety, which is also known as marriage. Half of the marital assets goes to the deceased spouse's estate. Then there's tenancy in common. So you have A, B, and C. they own property together. If A dies, then the fair market value of A's shares go to A's heirs. So that's tenancy in common. Life insurance proceeds. Life insurance proceeds in a spouse's name go onto their estate regardless of the beneficiary. So if a husband dies and he has life insurance in his name, even if his wife is the beneficiary, it still goes on to his estate. So it's not income to the wife. However, it goes on to the estate. So and where this comes into play is if you have like this massive life insurance policy, of course it's a little less important now that they increased the exemption to over 11 million. But before it was like 5.5 million or whatever. And you have someone with a pretty sizable policy where they thought they were helping their spouse out by taking this policy, and because it wasn't going to be taxable once they got the big check, well, it actually goes onto their estate, and it could put them over the threshold for having to pay estate tax. So something to keep in mind. Now let's talk about estate tax from the beneficiary standpoint. Property received through inheritance is not income to the recipient, and the property value is the fair market value at the date of death or 6 months later at the alternate valuation date, whichever you choose. If the property is sold prior to the 6-month date, but they use the alternate date, then the fair market value at the date of sale is used. So person dies, you can use fair market value of the property at the date of death, or if it's advantageous, you can use the fair market value 6 months later. You get to pick. But if the property is sold after the date of death, but before the 6-month mark, and they go with the 6-month mark for the valuation, then you use the fair market value at the date of the sale to value the property. And inherited basis in property automatically assumes a long-term holding period. Let's talk about distributable net income. This is calculated for both trusts and estates, and it's taxable income minus expenses from income production. So if you see the term allocable to corpus on the exam, it means it's not taxable to the beneficiary. And the beneficiaries of estates and trusts, let's talk about them. Trust beneficiaries only pay tax if earnings are distributed. Estate beneficiaries pay tax on distributable net income regardless if distributed or not. A 1041 fiduciary return is due if the estate has over $600 in gross income, and estate admin fees can be deducted either on the 1041 fiduciary return or the estate tax return. This concludes Chapter 4.